Hi, everyone. I'm Andrew Bracken. I'm a partner at Gradient. Gradient is an early stage AI focused venture fund. We've been around since 2017 and over $1 billion under management now, investing early in AI companies. And so back in 2017, we were obviously some of the small number of investors focused on AI, and now there is a greater group, and it's probably pretty common for VC funds to be investing in AI. But we've been lucky enough to back a number of category defining companies like Lambda Labs, Labelbox, Streamlit, Writer. And today we're going to talk about seed to Series A funding. I'm going to skip over this. Here are some of the companies we've backed since 2017. Maybe quickly, just context on us. Google is our only LP, but we operate very independently. And so we invest in products kind of across the spectrum. Sometimes they actually compete directly with Google. Often there's like a collaborative angle where the companies can leverage Google as a partner. But we've invested kind of across sectors, including infrastructure, application layer, usually investing at the seed stage. And so you can see here, many of our companies are now kind of much later stage, and we've seen them go through that life cycle of raising the seed round, maybe with Gradient, and then going on to raise a Series A, a Series B, C, etc., from other investors. And so one of the core pieces, I think, of the value we provide is helping founders tell that story and raise further capital from later stage investors. So today we're going to split this up a little bit. We're going to start with a little bit of an update. Let's talk about where the fundraising market is at, especially in regard to seed to Series A. And then we'll talk about some strategic concepts, some strategies, and some tactics you can use as a founder fundraising, maybe some process recommendations. And then I'm happy to answer questions if you have specific questions. I don't think we have to just talk about seed to Series A. If you have questions about raising a seed round, questions about how funding works in Silicon Valley, I'm happy to answer those questions. Just throw those questions in the chat. Maybe briefly some context on me. As I said, I'm a partner at Gradient. We're actually a pretty small team. It's about 10 of us in total on the team. And so pretty much a generalist, focus on broad spectrum of companies in AI. Prior to this, I was a founder, so I've actually gone through this myself. Went all the way through to Series B with a company called Vial, VIAL. And so, I've personally raised a seed and a Series A and a Series B, and can definitely empathize with the challenge on both sides, on the founder side and the investor side. Quickly, I want to give you a market update. Let's talk about what's going on in the market. I think it's helpful for you to understand. A lot has been changing. And so, I actually put together this presentation about 6 months ago. And when I was updating it for this presentation, it's actually a lot more optimistic today, which is good. All of the metrics I've looked at for Q2 are dramatically better than Q1. And you can see here, total funding has ticked up, from Q2 to Q1 to Q2. I think what I would say is, within the AI world, there is much greater interest in investing in companies, both at seed and Series A. Kind of outside of AI, the Series A market is still a little slow, but as the data in this deck shows, I think it's recovering pretty quickly. And so, just some interesting statistics here. The total dollars invested in seed rounds in Q2 of this year was 1.7 billion, which is down from 2021, 3.5 billion. For Series A, it was $4.3 billion invested into Series A's compared to 14.7 in 2021. That's still down 70%, even if you take into account, the fact that we actually had a pretty nice jump in Q2 from Q1. So what I would say is, as you can see here, there's far fewer dollars flowing into venture, into Series A's than 2021. In 2021, many companies would be able to raise a Series A. It was kind of like a foregone conclusion. If you had a pretty good team, if you had some good early traction, you're essentially guaranteed a Series A. I think in 2024, it looks very different. It is absolutely very feasible to raise a Series A or a Series B, but the market is no longer, as advantageous. I know folks are throwing in questions. I'm going to get, maybe after this market update, we can run through some questions, and then I can go into some of the strategy stuff. Another interesting stat here is that down rounds are kind of trending down, which is good for founders. In Q1, 25% of rounds were down rounds, which is kind of a wild statistic. That's trending down again. I think if you raised at a really high valuation a number of years ago, you may have to accept that you're going to have to reset. But I would say that's really just an outlier for companies that raised, at substantially high prices. I wouldn't overthink this if you haven't raised too much money yet. And finally, I do believe that the remote startup era is over, or is less appetizing to investors. I think investors are excited about AI, and in AI, it's incredibly competitive. There are teams moving quickly in each kind of segment of AI. And so it's hard to make the case that you're going to win a market if your team isn't working kind of together. And I also think it's harder if you're not based in kind of one of the major tech hubs. And so, one interesting trend, Y Combinator has kind of moved all of the companies back to SF. They're back in person. They're requiring they move to SF for the program. I think that's just a broader trend we're seeing, where in COVID, remote work was incredibly common. Now we're seeing more of a hybrid model where folks are kind of coming back into the office. And I think investors are definitely following that trend. Cool. Let me get some of your questions quickly, and then I'm happy to dive into the strategy side. So question here, what are the key ingredients for a successful Series A and Series B fundraise? I think I'll talk about that today. But the biggest thing I would say, the biggest difference between seed and Series A and kind of onward is telling the story of how your business gets big. I think when you're raising a seed round, it's often, we have an amazing team, we have a good idea, maybe we have an initial product. When you're going to raise larger amounts of funding, you kind of now need to tell the story of how this business gets quite big and how you're the team to do it. Like, do you have the, what gives you the right, and what's your insight into how this becomes a very significant company, and are you the team to do it? And so I think you just need to have that. Clearly you need many pieces in place, but one of the biggest pieces is just be able to tell the story, and tell the story about how this becomes a, massive company. I worked with a tech startup which raised 200 million Series A. Now we're trying to, I don't quite understand the question. I think you said, I don't know why it took so long to get the funds transferred. It's not, generally I would say, the seed rounds are very fast to close because you can often use a safe or a convertible note, whereas Series A's are usually priced rounds almost always, and there is more kind of legal back and forth. And so I would expect it to take sometimes a couple months to close, but anything greater than that is pretty rare in my opinion. Another question here, do we invest in the UK? Do we consider the London a tech hub? We do. I would definitely consider London a tech hub. I think it makes a lot of sense in this market to be close to the talent and be close to other investors. Cool. Let's see if there are any other questions. I'm currently raising a pre-seed round. I'm having trouble connecting with the right investors. Do you have any advice on this? You're based in the Middle East region. Cool. I would say, again, it might make sense to be based in kind of a larger tech hub. So I would look at where there's talent, where there are investors, and also where your customers are. So if your customers are in the Middle East, it may make a lot of sense to be based there. If your customers are based in the US, if your customers are based in Europe, it might make a lot more sense to base the company closer to your customers. Another question here. What are the usual terms of a safe for a pre-seed round in Silicon Valley? We're trying to raise a $1.5 million pre-seed round. I think there's broad variation. I would say in Silicon Valley, mostly folks use safes rather than, or convertible notes rather than kind of priced rounds. For smaller rounds, usually there'll be like a, usually they'll be investing on kind of a post-money valuation, sometimes pre-money valuation. For a pre-seed round, the terms I would usually say are at the lowest end, maybe like 5 million post, up to maybe like 3 to 5 on the low end. Like maybe you have absolutely nothing and it's just a super early bet, up to 15 million post on the high end for a pre-seed. And then for seed rounds, it kind of starts usually around 15, going up to can go quite high. But I would remind you that not all companies raise, and so that's kind of biased toward the companies that do end up raising. And I would say that's the biggest difference. We'll get into the strategy now, but the biggest difference between 2021 and 2024 is a lot of companies just don't raise now. Companies will try and will ultimately not raise. Whereas I think in 2021, most companies that went out to fundraise would ultimately fundraise. So I think the numbers haven't shifted that dramatically. We're not seeing like a huge drop in valuation, but that's because maybe a fewer number of companies end up getting funded, and the ones that do are just of a higher quality. So let's quickly talk about why the fundraising market's tough. You may know this, but I think it's important to reiterate. Obviously, there's a tough economic environment, and with interest rates where they are, it actually like discourages investment into venture. If you can get 5% from the Fed, why would you invest in venture funds? And so that, and then the kind of other effect there is we're not seeing as much M&A and exits as we used to. The stock market isn't doing as well. Venture companies in the stock market and SaaS companies are trading at much lower multiples. And so these two environments are making it challenging for venture funds to raise money and ultimately deploy money as fast as they were. I think generally this just leads to a higher bar to raising your round. The good thing is, of course, some of the macroeconomic effects seem to be changing. We're seeing interest rates coming down now. I think we're starting to see a little more M&A. We haven't seen the IPO market kick back in yet, but I think as we do, hopefully that will only be a positive effect. And clearly AI, ton of funding and exits happening in AI. And so I think we've seen that the AI market is slightly more robust and optimistic than kind of the broader like SaaS tech market. But of course, the AI market is also very competitive, which makes it hard for new startups. Just a couple quick strategic points here. Clearly, one trend we're seeing is companies are cutting burn. I think with AI, you can be a lot more efficient. You don't need as large of a team maybe as you did a few years ago. We're seeing companies that maybe used to be very operationally complex start to use LLM-based tools to automate functions and start to cut costs. I think generally we're just seeing companies try and be more efficient. I think if you're going to raise a Series A in this market, you want efficiency. No investor wants to invest in a company that has very high burn, because given it's a tough fundraising market, you don't want to be the last investor in, the investor that puts money in and then the company ultimately runs out of money. And so more than anything, in this market, I would take slightly lower growth in exchange for dramatically reduced burn. So I would say trying to keep your business efficient is very important in this market. And a question that comes up to me all the time, we're going to get into now, like, how do you raise a Series A? What do you need to raise a Series A? And very often folks say to me, oh, well, you need $1 million of ARR, or you need $2 million, or you need 750K. I would say that raising a Series A is not about an arbitrary metric. It's about finding product market fit. Series A investors are post product market fit. If you don't feel like you have product market fit yet, I would recommend raising. The nice thing about safes is it's easy to kind of keep raising and expand your seed round. And so we've seen a huge number of seed extension rounds or seed 2 rounds. These used to be kind of fairly rare and maybe even a negative signal. I would say now these are like totally par for the course. Many companies raise extension rounds. Some of the best companies we've invested in at Gradient, we've maybe given them an extension round. Really, the extension round just reflects the company isn't yet post product market fit. They don't yet have every piece on the right here locked in. And so let's give them a little more capital to keep going, to keep building toward product market fit. And then ultimately, we often see those companies get there and raise substantial Series A rounds once they have some of the key pieces on the right here. So to me, what is product market fit? Show that it's working and show how it gets big. We've talked about that today, but I think that is kind of the key combination for venture investors. Venture investors don't just want an ARR metric. They need to understand, how is this business going to become, a world-changing, category-defining business? Because ultimately, that's the only way they'll make money. You probably know this, venture is all about the power law. So a very small number of companies end up returning your fund generally. And so you have to make the case for how your company can return their fund. So the pieces I look for at Series A is fast growth, of course. I would say if you don't have significant year-over-year growth, you can still raise a Series A if you have kind of 1 to 2 quarters of very good growth. So I think you can tell the story that that you figured something out in the past 9 months or 6 months, and that's why you're raising now. You don't need to wait for a full year, I would say, but you do need to kind of reliably show that you figured something out and you're growing quickly. It's not like a one-off quick, 1 quarter of good sales. You want to hopefully show a couple quarters where the business is working. And to that point, you want to show you have a proven go-to-market. So, at Series A, I care a lot about, does the founder understand their go-to-market? Have they proven it out themselves? So have they nailed the founder kind of led sale? And are they now kind of transitioning to the maybe first sales hire who's going to scale the go-to-market motion? And so I think when you're raising a Series A, or if you're raising, a larger seed round, it's great to have these pieces locked in. The third is product market fit. Are your customers happy? Are your customers renewing? Are they growing their spend on your product? If your early customers are churning, if your early customers aren't leaving good references, you probably don't have product market fit. And you'd be surprised how often companies list references or customers, and then you speak to the customers and they're actually not so happy with the product. And of course, I've been a founder, so I get it. It's hard to be everything to everyone, and you're still early in your journey. But I would say if you're going to go raise a Series A, have confidence in these points. Like, be confident that you've solved a problem for your initial customer. Maybe it's not the full problem you end up solving. Maybe you're only solving a small piece of their full workflow. But you want some happy customers that are renewing to make the case for why you have product market fit. And finally, it needs to be a venture scale opportunity. We've talked about this. VCs aren't in the business of investing in non-venture scale opportunities, just given that 6 or 7 out of 10 of companies will ultimately not be meaningful in returning the fund. And so you basically have a small number of companies that end up returning your fund. And so you basically want every bet you make to be a very large potential opportunity, so that a small percentage of them end up achieving that. Let me take another look at the questions here. Let's see. Let's go back into the Q&A. I just got my first customer in my startup. Can I go for seed funding? I would say it's a great question. The market has changed a lot. In 2021, again, I would say a seed round, the pre-seed concept didn't really exist. A seed round was, some folks with an idea and maybe an MVP, you could go raise a seed round. I think in the last couple of years, we've had this concept of pre-seed increasingly grow and become more prevalent. And so the bar for raising a seed round from a Silicon Valley fund is now probably you need some traction, like you need some revenue. You don't need as much as we'll talk about here for a Series A. You don't need $1 million of revenue, but you probably want a couple good early customers that can help you tell the story for the business you're building. And so I would say for a pre-seed, the bar is low. Generally, you just need a great team, a good idea, maybe the beginnings of an MVP. You maybe even just an idea. You can go raise a pre-seed round. Usually that would be under $1 million, usually under $10 to $12 million cap. You know, and you also have accelerators like Y Combinator that kind of fit into this model. There are a bunch of other good ones like HF0, which is AI focused. There's the A4 Fellowship. There's the Sequoia ARC program. So there's South Park Commons. Those are all great kind of pre-seed programs that you should check out if you're interested. But then seed stage, we're now seeing it's almost like halfway to Series A. Like seed stage, if you're going to raise a $2 to $5 million round, you need some meaningful traction. And I would say the more money you raise, the more traction you need. So the larger seed rounds we're almost seeing now, if you're raising a $5 million seed round and you have 500K of ARR or 700K of ARR, you know, a few years ago, that might have been called a Series A. And so we're seeing Series A bar kind of remain high, and then the seed bar kind of the seed market expanding to kind of fill the gap. So large seed rounds now almost look like Series A's. And then, you know, you do still have the traditional like two on $15 million post type seed rounds that are kind of were the norm in the past. Let's talk about Series A metrics. So this is a little guide to, I think, how you can think about raising a Series A. I don't think you need everything here. Most companies will kind of fall on different points for different for each of these items. But I would say these are like, it's a pretty nice benchmark of what you probably want. So everyone talks about ARR. I would say, how quickly have you won this ARR? Being an important question. I would much rather invest in a company that has 750K of ARR rather than 2.5 if you know, that revenue is high retention, was, you know, acquired in a reliable sales motion. So like it wasn't 5 years of slow slog to where they are today. It was like a pretty reliable sales motion where they figured out what the customer wanted and they delivered it and closed, you know, 700K of deals. To me, that's much more enticing. So I care a lot about churn, about you know, year over year growth, more so than just total ARR metric. The other thing I think is pretty important is what's your ACV, which is kind of like what we're talking about over here. I would say if you're below a $50,000 ACV for an enterprise type sale, it becomes challenging to kind of hire reps, hire account execs and SDRs. And so under a 50K ACV, we usually think of that as kind of like more small business type sale. I think if you can make the case for growth, that's very compelling. And I actually have made some investments that look like that. By the way, we're just talking about enterprise here. So if you're a consumer business, none of this really applies. The numbers look a little different. But for enterprise businesses, if you can get above the 50K ACV mark, that's when it gets quite interesting. And if you get above the 100K mark, I think then it's really exciting because I think investors can then tell themselves, you know, how does this get to meaningful revenue and ARR? I think, you know, it's much easier if you're selling 100K deals than selling $10,000 deals. But at the end of the day, it's all about, can you reliably acquire these customers? Let's take a look at the questions again. Can I share the benchmarks for consumer businesses? You know, I don't have it. I didn't prepare that for this deck because we don't invest in consumer. But what I would say is there's actually a really good article that I'm going to find right now that I read in preparing for this that I'll post in the chat. It's from Initialized Capital, who have done a lot in consumer. It's a few years old, but I still think it's very, very helpful. And they talk about kind of some of the Series A metrics for consumer, for direct to consumer, and other kind of segments here. I would say for consumer businesses, again, it's all about CAC payback. How much does it cost you to acquire a user, and how quickly do you pay that back with revenue? What is your churn? So I've looked at some AI consumer businesses that had really impressive growth and really impressive revenue, but quite high churn. And so it's a leaky bucket, right? And that's hard for an investor to get excited about. If you're spending all this money to bring users in, you're monetizing them effectively, but ultimately a significant chunk are churning every month. That you don't want to invest in that type of consumer business as an investor. Usually you want to invest in businesses that have like high customer satisfaction, pretty high retention, like users love using the product and want to stick around. But yeah, I just posted that article. I also use the Carter Series A private markets report for this that I'll post in the chat. So I found that pretty helpful too. By the way, my email is here. So I know folks are posting in the comments. Feel free just to email me if you want to chat about your company. You don't have to like post in the comments. It's bracken@gradient.com. Let's talk about running a successful process. And maybe before that, let me just quickly review the question. Great question. AI market is quickly getting crowded. How do VCs like you figure out which companies to invest in? Totally fair question. We struggle with this every day. I mean, there's a balance, right? Like in some ways it's easier than ever to build a really cool AI product. And so the bar is lower and it's easier to build, maybe to get to 500K of ARR with an AI product, because it's easy to build like a really cool demo and get some early customers. It's harder to like build a moat. So I think what we look for, a few things. We look for a data moat. We look for like a network effect around the data in the business. And so is there some kind of compounding effect where this business is building a really unique data set that will give them an advantage? And so a good example of an investment we made is in a company called Rad AI. It's an AI radiology platform that was founded back in 2017 when Gradient was formed. I think the cool story there is Rad AI have built an incredible data set that continues to get better. As radiologists use the product, it gets better and better. They have a greater data set and they're able to like better serve those radiologists. And so there's a really cool network effect with that business. And as more people use it, it only gets more effective. And so Rad AI have now been able to sell like a massive percentage of radiologists in the US. I think they're really well positioned, and I think selling to healthcare providers and selling to health systems is generally very hard. And so the data strategy there, I think, was critical in them being able to actually deliver a product that worked and build a big business. So I think those are the types of things we look for. We look for incredible teams. We look for go-to-market know-how. So if you're building, a software product for, let's say like manufacturers, I don't have to just underwrite, is this a good product? Do I like this team? It's also, does this team know this market? How are they going to sell into this market? Even data might not be a moat. Yeah, it's a great point. I mean, listen, the challenge with AI is this market is changing rapidly. And so really all you can do as an investor is back amazing teams that are moving quickly and are go-to-market focused. So it's absolutely true that it's hard to, AI is very competitive and it's hard to build a moat. So I think someone's asking, what do you think will differentiate AI startups that transition from Series A to Series B? I think once you're in the Series A realm, you now need to be able to tell the story of how this becomes a real company. It's not just early metrics, great team, great product. It's now maybe a multi-product company that's going to be a market leader. I think there are companies like Harvey and Ambience and there are Writer, which is a portfolio company of Gradient, that have done an amazing job of nailing the enterprise sale. They've become more than just a tool. They're kind of becoming a suite of tools that solve a deep need for a customer. And so I think that's what you need to do as an AI company. Writer now have Gen AI, like LLM based generation of marketing materials and copy is pretty commoditized generally. I think Writer have done an amazing job of building a suite of tools, of building some of their own models and fine tuning to offer a greater kind of enterprise grade product, greater security. I think Writer have done an amazing job of nailing that. And that's kind of what I think the gold standard looks like. You can't just be an LLM wrapper. You have to build a product that's kind of enterprise grade and stands on its own. And I think that's why VCs are intrigued by the opportunity for AI in more regulated industries where the moat looks more real, because it's just a higher barrier to entry. Let's keep going on some of the process questions and strategy stuff here. So I just want to quickly run through this. Here are some options when fundraising. I would say my preference is always for this curated process. And so what that looks like is finding, figuring out who are the high likelihood investors that make sense for you, and running a more curated process. So what that looks like is getting warm intros to these folks, trying to line everything up. So build a list of your top preferred investors, find warm intros, figure out why this makes sense for them, and then run a more curated process rather than broad outbound, pinging everyone, broad auction process. I think this is probably the most effective strategy in this market. The other, I would say, is like the kind of market check type process where you really don't share to investors that you're actively raising, but from time to time kind of check in on the market, update them on the business, and let them kind of come to you with a preemptive type offer. Let them kick off the process. I would say those are the more effective than the broad auction process where you're just pinging a ton of investors, trying to get attention. Investors want to invest in companies that don't need them. And so it's unfortunately kind of the psychology of fundraising looks a lot like sales. It looks like dating. How do you run a tight process that gets folks excited? I think we have to close out here, but the biggest thing I would say, here's kind of you can take a screenshot of this. This is kind of the usual engagement flow for investors. I would say the biggest piece of advice I have for you is trying to time box this whole process. So I would line up investor meetings in a way that basically forces people to make a decision within a couple of weeks. And so don't let processes run wrong forever. Don't start some investor processes here and then toward the end of maybe getting toward a term sheet, start meeting more investors. I would try and line people up so that everyone's kind of taking a look at the same time, and it creates a more competitive environment for you. So those would be my biggest tips here. So I think we're at time. I'm happy to, if folks want to reach out to me, happy to answer more questions. As I said, my email is bracken@gradient.com. Feel free to send me a note, and I'd be happy to, happy to answer any other questions over email. So thanks so much for the time. I'm gonna end it here, and always happy to chat and happy to share more. As I said, can you receive the slides? Yeah, absolutely. If you want to just shoot me an email, I'm happy to send you the slides, but maybe the Startup Grind folks can share stuff too. But I wish you all the best of luck. Thank you, and good luck with the rest of the content today.